The shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver. And, that will put it on pace to be one of the biggest delivery months ever. This is a deal where, at the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short. To affect this, there's a battle going on right now.
That would be where I would say, okay, once we achieve that, let me just, again, take a pause. Let me analyze the charts. Do we see a pullback at that point before we continue much, much higher? But I think like 8 to 10K is very reasonable in the next 3 to 5 years on gold.
Andy Schectman and Gareth Soloway break down two sides of the same precious metal story, the physical and the technical. Andy highlights the extraordinary activity on the COMEX, where nearly 38 million ounces of silver are being delivered this month alone, one of the largest in history. At the same time, SLV faces a staggering 80 million naked short positions, a setup that reflects intense pressure between physical demand and paper manipulation. On the technical front, Gareth points out that gold's momentum may pause briefly before its next major leg higher. After such a steep rally, a pullback would be natural, potentially setting the stage for a run toward $8,000 to $10,000 per ounce over the next few years. Both analysts agree. The current setup signals a massive realignment of value between paper markets and tangible assets. If you found this analysis insightful, don't forget to like, share, and subscribe for more expert market breakdowns.
This is a deal where the shipments out of both the COMEX in New York or the shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver. And, that will put it on pace to be one of the biggest delivery months ever. This is a deal where, at the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short. To affect this, there's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. I think people need to think about this, and maybe this is why you're seeing big money start to move into gold. The central banks have been front running it, and now you see Bank of America, Jefferies, Morgan Stanley, JP Morgan. They're all saying they're reassessing their outlook on gold all the way up to 25%. And when you see Michael or the big bond trader, the bond king for BlackRock, that Jeffrey Gundlach, say a 25% allocation to gold is not overweight. I mean, that's just unheard of to say that. Look, the deliveries off of COMEX, to me, really more than anything, are telling you that the most sophisticated traders in the West feel the same way. And if they're going to knock the paper price down, well, they'll cover their shorts and they'll stand for delivery. And we're seeing that. It's an emotional thing to see price fall the way that it did, but it is really done in a very irrational way that isn't being reported, and they're dumping it in a matter specifically to affect that type of sentiment and that type of aggravation. And foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there is a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged in individuals and groups realize that it is indeed the Achilles heel of the entire system, and they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like NVIDIA and Apple that have defied gravity. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is a something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery an immediate contract in October. So what was interesting to me about it as well was some of I think it's Michael Lynch, I think is his name. I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on I want to say Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly traded illiquid market, period. No one would ever do that. They did. And it's done for effect, specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night or, after New York trading. That would change the outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1 and gold about halfway up. Because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional. And if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has the big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20. Sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25-25, 25-25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this, and all of a sudden they come in and buy over 600,000 ounces. Where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%. This was done for effect, and it was done either to cover shorts, to take possession of physical, or to rattle the bushes and make people think all of the things that the mainstream said, a lot of which were valid. Gone up 9 straight weeks in a row, was overbought, in need of some sort of a flush. Okay, I believe all of that. And if it had been done properly, the right way, over time, instead of all at once, when the market was liquid instead of when it was illiquid, well, maybe I'd believe that. But it was done for effect. And so I would suspect after I research tonight or tomorrow morning what happened today, we'll see similar footprints in the snow that we'll talk about, this exact same thing.
Andy Schectman outlines a powerful and troubling picture of what's unfolding in the gold and silver markets. Nearly 38 million ounces of silver are being delivered through the COMEX this month, one of the most significant totals ever recorded, even as SLV faces an 84 million share short position, representing about 15% of all outstanding shares. This suggests a deep disconnect between paper prices and physical demand, with heavy shorting designed to suppress prices while major institutions quietly accumulate physical metals. Schectman notes that major banks like Morgan Stanley and Bank of America have shifted toward gold allocations of up to 25%, a move that signals a significant change in institutional sentiment. What's happening now, he says, is a methodical transfer of real wealth from paper to tangible assets. Let's get into the interview.
Yeah, I mean, I think overall you have to be thinking 5K is the next big threshold, right? Human nature, psychology, which is a big part of investing and trading, it's always attracted to these bigger numbers. And obviously we got up to about 4,400 or so. Now we're correcting. I think the next push takes out those all-time highs, tags 5,000. I don't even think that's the end of the bull run. I think this could be a multi-year move, but that would be where I would say, okay, once we achieve that, let me just, again, take a pause. Let me analyze the charts. Do we see a pullback at that point before we continue much, much higher? But I think like 8 to 10K is very reasonable in the next 3 to 5 years on gold. Again, I'm not looking at, thousands of percentage gains. I think you have to be realistic in that sense. But where else are we turning? Especially with risk assets. And I think this is so crazy, right? Is that gold has been going to new all-time highs until this latest correction, while the stock market's been going to new all-time highs for months and months and months. Historically, that does not last. And I do worry that if the stock market corrects significantly, which I do think is on the horizon, more money eventually finds its way into gold. Yeah, so silver is one of the most remarkable, and this led me to make this call on silver topping out as well, is that it's the beauty of charts again, and I know it almost seems too simple to work, but it does, is that if you take a parallel channel and you just connect it to the low here in '08, so the financial crisis low, and connect it to the low of COVID, and you stretch that parallel up. And so let's just go back to this. So basically all I did was I connected those two lows. You stretch that parallel up to the 2011 high, and look at what it gave us. It literally gave us the top. And this is just the power of charts. And remember, charts are replications of human psychology. And so what it's telling us is that you're likely or probability wise going to get a pullback. And that's exactly what silver has done. Now, the bigger question is, how low does it go? Like, where am I as an investor starting to accumulate? All I'm doing here is basically drawing a trend line through these recent levels. And essentially, I'm looking for a move back to about $40 or so. We get back to $40, which, by the way, a week or two ago was like, that's so far away. And then here we are from 54 back to 46 in just a matter of a week or two. So don't be surprised if we get back down to $40 and you could accumulate all you want there. I still think silver's going to 60 to 62, probably early next year. And then beyond that, the sky's the limit. The only trigger here, and this is the only thing that people have to remember about silver, is that it is partially an industrial metal now, more and more, in fact. And so if the economy really here in the U.S. starts to struggle, there will be some downward pressure that the precious metal side of investing in it will have an impact on. And that's the only thing, versus gold is just purely a pure play on the fiat currency issue. And let's just go over that for those of you that are tuning in new, right? Let's look at this chart, because it's fascinating when you look at 1979 and mirror that with 2025. And just to take a look at this, we had the same run up early here in 1979. We had the same run up here in 2025. Then we went into this base of consolidation, and then literally 9 straight up weeks in a row in 1979 led to this big correction. And sure enough, 9 straight up weeks, and we're correcting as well. And a lot of people say to me, and this is a valid point, is that, this isn't the same, right? We have a very different scenario. It's true, and we're going to go over that in a second, but I think it's important to recognize that fear and greed are the same, right? And so while in 1970, Volcker was raising interest rates in the 80s, right? He raised it 15, 16, 17, 18%. Here we have the Fed lowering rates. We also had only 32% debt to GDP in 1979, 1980. We have 130% now. And so things are very different, but human psychology doesn't change. Now, how does the difference play out? The difference maker is in 1979, when we topped out, it literally took almost 30 years for gold to make a new all-time high. I think we make a new all-time high within 6 to 12 months, but the correction still needs to happen. I do. And if we go to this other chart on gold, I've laid out my levels already. We're already kissing the first level here at around 39.48. We got as low today as 39.71. That's going to be a first level of support. Second support and third support follows. And for me, listen, these are tradable levels, these first two. Once we get down to the third support and my max drawdown level, that's really where I start buying for the longer term again. And listen, I still have my long-term gold holdings. I want to be clear on that. But for me, I can't pay up here when I see past corrections. One thing I want to show you guys, and this is super cool. So let's go back to the 1979s. Where did gold pull back to when it had its first major bounce, right? And the answer is, if we look at this, look at the high of that push up where we consolidated. And if we draw a trend line there, that's virtually where we pulled back to before we actually got our first major bounce in gold. Well, what does that mean? Well, if we pull back in that same manner in 2025, that would bring us down to about that 3,500 level, which if we flip to this other chart, that's my max drawdown level. And so ultimately, while the correction is likely going to be a little bit painful for people that bought at 4,000 or above, I think, again, if you're someone with a longer term view, the differences in the government spending, the debt the U.S. has, debt to GDP, and interest rates, that tells you buy like crazy when it gets down to these levels.
Gareth Soloway, a veteran market technician, sees history repeating in gold's long-term trajectory, but under far more extreme financial conditions. Comparing the 1979 to 1980 bull run to today, he notes that while Volcker raised rates to fight inflation back then, today's Fed is cutting into a mountain of debt exceeding 130% of GDP. The setup, he argues, is far more explosive. After a strong rally to $4,400, gold is now correcting, and Soloway expects this pullback could reach the $3,500 range before setting the stage for the next leg higher. From there, he projects that the next surge could push gold to $5,000 and ultimately to $10,000 an ounce within 3 to 5 years. The message is clear: short-term pain could precede a generational breakout. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.